Hey everyone, Estelle here from Pepperstone and welcome back to Markets on the Move. Today I've got my eyes on the Hong Kong 50 index. So now just taking a quick peek at the daily chart, you'll notice something really interesting going on. After a big dip in January and some shaky rebounds in February, the price has been fluctuating between 16,100 and 17,200 since the end of February. But what's got me all intrigued is the recent V-shaped flip. Starting from April 12th, the Hong Kong 50 took a nosedive for 4 straight days, breaking through those late March lows. But then the bulls just charged in, pushing the price up for another 4 days in a row. Especially this Monday and Tuesday, we saw a whopping 3.5% surge, and the upward momentum still seems pretty strong now. So why the sudden change? How long might this rally stick around? And could we possibly see new highs for the year? I believe I'm not the only one wondering. So let's dive in and explore. First up, let's break down why the Hong Kong 50 went from bear to bulls. From the market sentiment perspective, it looks like the tensions from the Middle East have simmered down a bit. No major news from Iran or Israel this week. And you know what they say, no news is good news. With that, investors are starting to relax and, just shift their focus back to riskier assets. So actually, it's not just Hong Kong 50 getting a boost. We're seeing some green across the board in global stock market, including US, Europe, Japan, etc. Plus, UBS just upgraded their rating on Chinese stocks yesterday, bringing some good vibes into the market. Both mainland and Hong Kong stocks got raised from neutral to overweight, thanks to some early signs of consumer spending recovery. At the same time, China's got some good news too. On April the 19th, the China Securities Regulatory Commission just rolled out 5 measures to support the Hong Kong capital market. Those measures include expanding ETF Connect, bringing in rates, supporting RMB trading counters, further mutual recognition of funds, and facilitating more leading companies to list in Hong Kong. So actually overall, this move should help broaden the scope of the Hong Kong stock market and help some domestic players like public fund to get in on the action. And sure, the market might have been hoping for a little bit more lower thresholds for the Hong Kong Stock Connect or some dividend tax relief, but for the undervalued and liquidity strapped Hong Kong stock, it's still a win. And let's not forget about those stock buyers. They hit the record highs in the first quarter of this year. Some big buyers like Tencent Holdings, HSBC Holdings, and AIA Insurance, to name a few, scooped up over 1 billion Hong Kong dollar each in buybacks, boosting the value per share and pushing Hong Kong 50 upwards. Plus, the Southbound Connect has seen net inflows for 16 straight days. Whether it's because Hong Kong 50 is a bargain or because some of the better than expected Chinese economic data, foreign capital has been making its way back to the Hong Kong market for sure. Where did that leave us? With geopolitical tensions easing and some solid news and capital flows backing us up, it's no wonder that Hong Kong 50 is on the upswing. And unless those tensions suddenly flare up again, and with all the bullish news flow, I reckon Hong Kong stock will keep riding high in the short term, just like the rest of the global stock markets. As for whether Hong Kong 50 can hit new highs for the year, there's a few things to consider. Firstly, even though fundamentals have been looking up this year, earnings expectations for the MSCI China Index in 2024 have been slashed by 3%. So whether Hong Kong 50 can break into new territory hinges on key sectors like whether the property market's demand picks up and if earnings expectations see an uptick. And of course, it will depend on whether Chinese authorities roll out more policies to boost real estate market, loosen up financing, or stimulate the economy through special bond issuances. Secondly, apart from shoring up weak sectors, if we can find some new growth avenues with rise of AI narratives, it will give Hong Kong 50 a boost. And lastly, the timing of the Fed rate cuts is also crucial. Opening the rate cut floodgates will inject some capital flows into the risk market. And that's the key for index upward trajectory. So that's pretty much for this week. If you have any insights on Hong Kong 50's future, or maybe you are eyeing up some other markets, please drop your comments below and let's have a chat. Stay tuned with Pepper Sheng for more insights and updates. I'll see you in the next one.